This is the video for Chapter 6, which is on accounting for a merchandising business. So a merchandising business is going to be different from a service business that like we've been dealing with so far, where a service business is just selling their time, so they don't have anything additional to sell. A merchandising business is actually selling stuff. So you can think of Target or Walmart as a merchandising business because they don't make their stuff and they're not selling a service. They're basically selling items. So they buy their items to sell it, and then they turn around and sell it. So the key to understanding Chapter 6 is to realize which hat are you wearing in these problems. So first, we're going to talk about when a merchandising business is the purchaser. Because like when Target wants to sell something, they're not making it. They have to buy it first, and then they turn around and sell it. So a merchandising business can be the purchaser when they're buying the inventory or the items to sell. And then they could also be the seller and then turn around and sell it to a customer. So this first section of these notes is to show you the journal entries when our business is the purchaser. Now, the key new account in this chapter is merchandising inventory. So merchandising inventory is an asset, and it's going to be a holding place for where we put all our stuff, and it's going to hang out on the balance sheet until we sell it, and we'll take it off of inventory. So when we buy the stuff and it sits on the shelf in the store, it's going to be merchandising inventory. So first up, we're going to be the purchasers. So we would put on our purchaser hat. Now here are the journal entries for a purchaser. When a purchaser makes a purchase, they could buy it with cash. So we could buy inventory from a vendor with cash. And the debit for that entry is going to be to merchandise inventory. Now, merchandise inventory is an asset, so it is normally a debit. So when we increase an asset, we debit it. So we're going to buy some new inventory and put it on the shelf in merchandising inventory, and that's going to hold a debit balance until it's sold. We pay for it with cash, so our cash is going down, and so we will credit our cash. The next type of entry as a purchaser we'll have is if we purchase inventory again, but this time we purchase it on account. So we didn't pay for it yet. We're going to pay for it later. So your first entry is, again, we're going to debit the asset of merchandise inventory. Let's say this time we bought $3,000 worth of inventory instead of $2,500. And we didn't pay cash for it. So instead of crediting cash and cash going down, we credit accounts payable. Now, accounts payable is a liability, and a liability is normally a credit. So we have just increased accounts payable here by crediting it. So this is the purchase entry. Whenever we purchase inventory on account, there's going to be two entries. And this is the first one, where we make the purchase. Second, we're going to have to pay our bill. So the second entry is going to be to remove or decrease accounts payable with a debit. So now accounts payable is 0, and we're going to actually write the check and make the payment. So cash goes down. So the first entry is the purchase, the second entry is the payment. Another thing that is important to know when you're the purchaser is what are the credit terms. So credit terms look like these two examples I've written here. The first one, we would say it like this: 210 net 30. The first part of the credit terms is the number of days the number of days is 10, so the number of days is this second, let me cut it here. is the 10, and the 2 indicates the discount. So we're saying 2% discount if you pay within 10 days. And then if you don't take advantage of that discount in 10 days, then the second part of the credit terms is the regular terms. Then you need to pay the net or the whole bill in 30 days. So these are number of days. And this is whole bill. Okay? So let's read this second example. 315 net 60. Well, this means that this credit term would be 3% discount if we pay within 15 days. So the goal is we're trying to get our customers, or they're trying to get us to pay faster, because here we're the purchaser. They're trying to get us to pay faster. Of course, when we're the seller, we can also provide discounts. Okay, and then the net would be within 60 days. If we don't take advantage of the discount period, then all of it's due in 60 days. Okay, so how we record that is we're going to assume that everybody's a reasonable buyer and everybody wants to save money. So when we record the initial purchase, we're going to record it net of the discount. We're going to assume that we're reasonable buyers, purchasers, and that we're going to take advantage. So let's say this is a 2%. So this example would be 210 net 30. And if we had the original purchase above, like up here, we had $3,000 on account, what would that look like if we had bought another $3,000 of inventory, but it had credit terms of 210 net 30? So you would take your $3,000 of inventory that you bought, and you would multiply it times 2%. I know I said 6. 2%. Okay? So your 2% discount actually works out to be $60. So then you'll take your $3,000 minus your 60, and that is your $29.40, your net of discount. So that's what you will record as your debit to inventory and your credit to accounts payable, because we're going to assume we're really only going to pay the net amount and we're going to take advantage of it. And then your second entry will be the same. You will remove your accounts payable and credit your cash, because cash is going down for the net amount. All right, and another example of a journal entry that you would have is, as a purchaser, is if we return items. So we might get items that we've ordered and we want to send them back. So this is an example of we're returning $1,000 worth of inventory. And our original discount was, we bought it, let's say 210 net 30. So what you have to do is reverse the entry. So let's say this is $1,000 of this $3,000 we originally bought. So because we put it on here as inventory net of the discount, we have to take it off net of the discount as well. So you're going to take $1,000 times your 2%. That works out to be $20 of a discount. So that means that $1,000 was really put on the shelf or put in inventory at $980. So you basically reverse the entry that is this number one purchase up here. But since we're only returning $1,000, you only reverse $1,000 of it. So we are taking accounts payable out, we're removing accounts payable, so it's going down, and then merchandise inventory is also going down because it's a credit for that $980. Okay, so here's an example of a purchaser. So let's say we purchase $5,000 of inventory. Our credit terms are $315 net 60, and then later we return $2,000 worth of inventory. So the first thing that we're going to do is we're going to record the purchase. But for how much? So we're going to debit merchandise inventory and we're going to credit accounts payable, as we didn't pay cash for this. We know that because we have credit terms. So we need to know, that tells us how long we have to pay the bill. So we have 60 days to pay it, but if we want a 3% discount, we need to pay it within 15 days. So how much should we record it as? Well, we'll take $5,000 times our 3% discount, and that is a $150 discount. So $5,000 minus 150 is $4,850. So we're going to record our inventory net of the discount. And then later it says we returned $2,000 of inventory. So let's figure out, before we reverse it, because this is going to be our return, before we reverse it, we need to figure out how much of that $2,000 is in there because it's recorded at the net. So $2,000 times 3% is $60. So 2,000 minus 60 is 1940. So that's how much we're going to take out, 1940. We're reversing $2,000 worth of inventory, net of a 3% discount. Okay, so the last thing I want to do with this first example is figure out, or this next example, is figure out how much I have to pay now, because I've first was billed $4,850, but then I took out $1940 of that bill. So let's do a T account of our accounts payable. If we originally put on $4,850 and I took off $1940, then that means I have $2,910 left that I owe. That's also the same amount that's going to be in our merchandise inventory account. So if we want to pay it, we're not going to pay the $4,850 anymore because we returned some inventory. So we'll remove the rest of accounts payable and pay the check, or the bill, with a check, $29.10. So this last one is payment. Okay, so those are the main journal entries that you'll need to know as the purchaser. So now let's change hats. Now we're the seller. So we're the same business. We have bought, as a purchaser, all of our inventory that we want to sell. And now we're going to have common journal entries for when we sell items. So now we're going to put on our seller hat. The first entry that's important to know as a seller is when we make a sale. So we're just going to make a cash sale to start. Whenever we make a sale, all sales have two entries. The first entry is going to be to actually record the revenue. And the second entry is to remove the inventory. So sales is a new type of revenue account that we haven't seen before. Revenue. Okay, so as a service business, we used fees earned as our revenue account. As a merchandising business, we're going to use an account called sales to record our income. So because sales is a revenue account, it is normally a credit, and whenever we record our sales, we're going to increase sales with a credit. We have also increased our cash here with a debit. So we made a $5,000 cash sale, and so we've recorded our first entry. And then let's say when we were the purchaser, we bought that inventory for $2,400. So it cost us, the purchaser, $2,400, and then we turned around and sold it for $5,000. So we're going to remove merchandise inventory with a credit. So we're taking it off the shelf. And we're going to put it in this account called cost of merchandise sold, which is an expense account. So expenses are normally debits. So over here, you can see that we have a formula to see if we made money. It's for gross profit. Now in our multi-step income statement, this is step 1, gross profit. So if we take sales minus cost of merchandise sold, that will be our gross profit, and we can see if we made money. So here we had a sale. We sold to our customers for $5,000 merchandise that cost us $2,400. So we actually have a gross profit of $2,600. So we made some money here. Now, whenever you see that we sold something and we accepted credit card as payment, I want you to treat credit cards as cash sales, because really the credit card company is going to give us the money right away, and then now the customer owes the credit card company. So whenever you see that it was purchased with a credit card, you're going to do this first entry just like if these first two entries, just like if we had received cash. The only additional thing we'll have to worry about is transaction fees. So that credit card company is going to charge us fees for that service. Whenever we have fees to pay the credit card company, you're going to debit credit card expense and credit cash for the amount of the fees. Simple as that. Okay? Next, sales on account. So we still have our seller hat on, and we make a sale, let's say $7,000 of sales, but this time we didn't get the cash right up front. So you're still going to have these same two entries. You're going to record revenue, and you're going to remove inventory. And the only difference is that you're going to use accounts receivable as your debit to record revenue instead of cash like we did above. So here we have to wait until later to get the money. And notice we sold the items for $7,000 and we bought it when we were the purchaser. We bought it for $4,500. So let's see what our gross profit would be. We sold it for $7,000 and we bought it for $4,500. Then that means we made $2,500 is our gross profit. So we're making money. Okay, we could also throw in credit terms. So if we're a seller and selling the same $7,000 that we did in the previous example, but this time we're giving our customer some credit terms and possibly a discount. So we are selling $7,000 worth of inventory, and the credit terms are 210 net 30. So they could get a 2% discount if they pay it within 10 days, and no discount, but they still owe it within 30 days if they don't take advantage. So we're going to assume that our customers are reasonable buyers and that they're going to take advantage of this discount. So we're going to record it net of the discount. So you take your $7,000 times your 2%, which is $40. So if we take 7,000 minus 40, that is $68.60. So that's how much we're going to say is receivable. We're going to debit accounts receivable net of the discount. Record our sale amount at the same amount. And then our removing of inventory entry doesn't change. We're still going to take that off at the amount we paid for it here. And the last main thing in Chapter 6, this big topic of freight charges. So this involves the purchaser and the seller, or the buyer and seller. So the real question is, who is responsible for paying the freight charges when shipping is involved? So the first concept is FOB destination. FOB stands for freight on board, but we always say just FOB, FOB destination. So these are kind of like credit terms where when we are negotiating with our buyer, between the buyer and seller, we're going to decide up front what credit terms are and also what is the FOB situation. So if we say it's FOB destination, then basically the seller is agreeing to pay the freight. So with FOB destination, title does not transfer until it reaches the buyer. So at this point here. So once the truck travels all along this road and reaches the buyer, that's now when the buyer gets to take title of the freight. So if there was some kind of car accident or fire or some kind of problem with the freight before it reaches the buyer, then it's the seller's problem because it's the seller's freight until it reaches the buyer. So whenever you see FOB destination, the seller pays the freight, and the seller will record an entry that looks like this. Delivery expense, say it was $150 of freight charges, and a credit to cash for $150. If it's FOB shipping point, that's different. FOB shipping point means that title transfers here. So as soon as the seller puts it on the truck, then this whole road that the truck drives all the way to the buyer is buyer's responsibility. So if there was a car accident in the road here after it's been put on the truck, then the buyer has to deal with it because it's the buyer's freight. And the buyer will pay the freight charges when it's FOB shipping point. When the buyer pays the freight, then the buyer is going to use that freight charge as part of inventory costs. So notice we don't debit delivery expense here when we're the buyer. We debit merchandise inventory, and it becomes part of the cost of the inventory. And then we'll credit cash. Okay, so those are the main points from Chapter 6, and I'm going to post some practice along with the practice answers. And do let me know if you have any questions, and good luck on your homework.